Good morning, ladies and gentlemen. Well, the risk dial hasn't really moved this week. It's up at 63, which basically means that the trend of the spreads is still positive. But if we look at the scores, we don't really see very much. We started the week around the 59 and we closed at 63. So this is not giving us any cause for concern. But there are many technical signals which are beginning to say that a short-term sharp reaction lower in risk is indeed likely, and we need to have a look at what deviations is saying and also what the technical indicators are saying. The S&P deviations is now beginning to actually look quite bad. I would have thought that it's looking more like this period here, i.e. we're going to contract and we are going to have the support here at 32.68, 32.70. That is where the first support comes in. I don't like this picture simply because there is a sustained loss of momentum and we need to build a new base before we can start going up. Don't get me wrong, I still think that we resolve higher, but the very sharp drop from the top tells me that probably this is not over. If we look at the individual sectors, we will see that none of them are really at support. We have a lot of room in all the big ones like XLK, for example, to have a very, very sharp drop, and we will go through the tech picture later. That's the sector that concerns me most. So it's nothing to do with coronavirus and things like that. It's more to do with the shape of the yield curve, what bonds are saying, and also where we are in the technical phase in various big sectors like XLK, XLF, XLV, and XLI. And XLY is also one of particular concern because now we could easily come off another couple of percent. So I'm flashing a very real warning here that the next couple of weeks are going to be difficult. I'm not saying there's a change of trend afoot. I'm saying that the market could easily give up some of the multiple expansion through fear. Whether that fear is rational or irrational, it really doesn't make any difference. But we are talking about the possibility of a sharper reaction down there anticipated even last week. Yet another warning comes from the shape of the Blue Angel curve. As you can see, last week it came down quite significantly. The slope is no longer upward sloping, it's now downward sloping. Is there a possibility that we revisit the times 18 line? Absolutely, and that's around 3200, 3220, whatever it is. So that is another 100 points, another 3%, which is absolutely possible. Okay, absolutely possible before we have another reaction higher. And I will show you what the individual spreads are saying. They're saying that tech is in great danger. Okay. Take it as you will, but that's what the technicals are saying. I'm not probably prepared to go in heavy for this week. I probably want to be quite light. Overall, tech I really don't like, but we will see why. So many warning signs out there that it really would be foolish to ignore them. This is a big one. A fundamentally big one, and when you get a conjunction of fundamentals and technicals, you tend to see a pretty good reaction. On to bond land. What are the bonds saying? Well, these are the twos, and as you can see, they are basically still saying that the trend of yields is lower. To me, now looks like the twos will touch this 115 area. Simply weight of money going for safety. I think the market has decided that if this situation persists, that there is a very good chance that global supply chains get impacted and that certain countries go into recession, and that the Fed will be quick to act and drop the rate around 25 to 50 basis points. I tend to agree with them. I think the Fed will try to do everything possible to sustain the global economy, and that they will see even an overreaction to the downside in terms of easing as preferable in terms of dangers to the future economy than not acting. To me, the interesting thing is that the tens twos, even though it tries to go below this 13, 14, whatever you like to call it, level, is not really managing it. From a long-term perspective, from a really long-term perspective, I think buying the yield curve is almost an assured bet. Why? Because either the fears will be realized, and then what happens is that the Fed eases aggressively. They've told you already they are going to be very aggressive in the first instance, thinking that the more aggressive they are, i.e. they're not going to start doing 25 now and then nothing. They're either going to really throw the kitchen sink at it, or they're going to do nothing. So from a really long-term perspective, the twos, tens could go up to 100 basis points. While on the downside, the risk reward is what? They might go down to, -2, -3. So you're risking 17 to make 70. So it's a really good risk reward on the upside, because I think that they could easily take rates to next to nothing, in which 2 years, in which case 2 years are trading a half, and I really don't see that being a danger. From a really long-term point of view, the best way to play this thing is probably long twos, tens. The US side is actually showing far more bullishness in terms of bond prices and lower yields than the German side. Germany has basically decided that the ECB is unlikely to do very much. And you can see the fives are basically just touching all the time this line of support, which I gave you, is around 61 yield. And if you look at the 10-year in Germany, okay, it's slightly heavier, but it's still holding that support line. And I really would leave these alone. This was the risk-reward area, and this is not the risk-reward area. You have very little on the downside compared to the potential for the upside. But what that does do, and I've been harping on about this, is makes the spread between 10-year Germany and 10-year US keep on coming in. And I really see no support now till about this area here, which is 182. And then finally here around 172. This tells me that bond yields are headed still lower. I know that is another warning to me. Bond yields going still lower ultimately will be bullish for equities, ultimately. But in the short term, it could provoke a nasty reaction down, and that is what I'm worried about. All that means is that we're going to get much better levels to be long at. The dollar has done nothing wrong. It basically has touched the 99.83 level, which we said was very important on the weeklies, and it's now in the process of correcting a very overbought situation with very good support at around the 98.54 level. 98.54, and you're looking to buy calls for the upside. Certainly something that I intend doing. On a daily point of view, you can see exactly the same thing. 98.50 is going to be very, very good support for another move higher. I mean, this is, what is it, 0.75%, 1%. nothing that we can't do in the course of a few days. So really the dollar remains bullish because it's making higher highs. The momentum is with it, and really this retracement back to 98.50, 98.30 is going to be a bit of a godsend to buy the DXY. I was wrong about gold. Gold went up, but I think this is all it is liquidity. Now, I'm not saying liquidity is not important, of course it is, but it's short-term liquidity. It's people parking assets where they don't know what else to do with them. To me, an environment which is as disinflationary as the collapse of worldwide supply chains is not one which is a natural bull for gold. And an environment where people are buying dollars hand over fist is not a bull for gold, but it's a short-term repository for people who don't know what to do with their money. As soon as the situation stabilizes and people find out what the level of risk is, i.e. where the market clearing level for equities is and the yield that people want to buy them at, then we will see a major reversal in gold, because why on earth would you hold it in that environment? I don't see why you would hold it in this environment. So, but technically speaking, if it breaks this 1658 level, it's looking bullish. There's absolutely nothing to be said. We are looking at 1900. That's all there is to it. But I don't trust it. I just don't trust it. I don't see why fundamentally this is a gold environment. This to me is a short-term, let's get the worry of this coronavirus and the US election out of the way, and then things can really start picking up again. Unless the US yield curve starts going negative, I really can't see a bullish case for gold. Well, with equities, and this is where it starts getting interesting. This is the 195 minute, which breaks the day into two. It's done really nothing wrong apart from it's turning these moving averages, these short-term moving averages. This is the last line of support with the Bollinger Bands and this last moving average, and it comes in spot on at 33.20, which has always been my level. Below there, we start accelerating, and if we go through that level, we definitely will trade around the 32.50, 32.55 area. That is almost a given to me. That's another 80 points, okay, so that's another, call it 2.5–3%. Now, what would make us do that is the real question. Never mind. First of all, before we try to answer it, let's go at and have a look at the other time frames. Now, this is the monthly time frame, and this is the one that worries me most, because we hardly ever accelerate faster than the monthly Bollinger line, and the monthly Bollinger comes in around the 33.20 area. Okay, so this is arguing that really we are going to see the 33.20 area quite a few times, both from the downside and from the upside. But here are the ones that start to worry me even more, and that's the weekly. If we start breaking this moving average, this one is almost assured, and that's 32.80. Okay, so 32.80 will come very quickly if we break 33.20. Okay, that's 40 points. You might say that's not a hell of a lot. But if we start breaking that, we are going straight down here at 31.85, and that is actually very good support on the monthlies, but also we have the possibility to go down all the way to 32.20 or something like that. And that would be a, let's call it a 350 point move, which is a 10%er. And that is absolutely possible here. Okay, absolutely possible. Why is it possible? Because the technical situation is so weird. We've had, I'm not going to show them all to you, but we've had the RSI divergences. We've got divergences in MACD. We have all sorts of divergences on the weeklies. So that is why I'm saying we have to play it with options, and we'll have a look at volatility, which also implies that things are not all that brilliant. If we go onto the dailies, you will see that really, breaks 33.20 area, it's gonna gap down to the 32.75.80 area, and below that we have nothing until the 32.20 area and the close of a couple of Fridays ago. So this could, then people start arguing, head and shoulders and stuff like that. All I'm saying is that we have the technical potential for a sharp break lower, and that will be led by tech, and I will show you now why. This is the chart that scares the bejesus out of me, and it's NQ. The same applies for QQQ, and it's a monthly chart, and if we enlarge it, we will see how far beyond all Bollinger Bands we are. The Bollinger Band comes in at 9,180. I think there is a very distinct possibility that we retrace, at least 0.382 of this whole move up. And that comes down at 8,700, but it's more probable they will retrace 61.8, which is 8,050, and coincides with these highs here. In 1 month or maximum 2, we could have, this kind of a move and up. It's just a question of where you buy it, but all I'm saying is that you have a very real potential for some very nasty behavior in NQ. Now, what would that imply? That would imply probably that the semiconductor space and the chip space gets killed on the back of some coronavirus thing, and or some disruption as a result of Super Tuesday in the States. A lot of people have been buying NQ and tech, saying that they are immune to just about everything, and that is, yes, they are. They should be immune to all these things in the long term, and they will be. It's just a question of how far technically they push it lower to make people stop out before they take it back up. I'm a bull by nature in this market because yields are low and yields will continue to be low. But I do think that the technicals in the next couple of weeks matter, because we have this conjunction of this uncertainty about the coronavirus and the potential for Super Tuesday, and the fact that we're so overbought and we have so many divergences on the weekly and monthly basis. I just think that this is a coincidence which is silly to ignore. On a weekly basis, NQ, we are so far away from any support, it's frightening. What we could do is look at this level here, 93.25.30. If we start going outside weak reversal below that line, we easily come to this support around 9,160. We most probably come all the way down to 8,670 very quickly in a couple of weeks. And that is what is potentially going to drive SPX lower. XLK is the largest sector, and therefore, a quick 5, 6, 7% in XLK, which is a very normal move for them, easily moves the S&P by a couple of percent. And this is also what is worrying me. This is the ratio of the Dow against QQQ. And you can see that it's been in this perfect channel for such a long time, and I've been trading it very nicely. Okay, so it spiked a little bit, but it's straight back. I think that the odds are that it goes back to the 200-day moving average, and that is a 10%er. Okay, that's a 10%er. So I'm not saying it goes 10%, it could go 5, it could go 6, but a 5 to 6% differential move between QQQ and the Dow has the tech sector basically on its knees. And that is a significant possibilities. So I would say reduce your risk. This is a very bad level to be outsized risk on in the tech sector. It could be that the safest thing to do is to go into the safety of the big stocks like JP Morgan and Disney and those kind of stocks, and really stay away from the Momo stocks of Apple and things like that. That is all I'm saying. I'm afraid that the tech sector is really going to drag down the S&Ps over the next 2 to 4 weeks. And I've been calling for 3,400 in the S&Ps for such a long time, and having got there, to have a 5, 6, 7% retracement is nothing. A welcome development. That's again all I'm saying. I would not be fighting long for risk on at this level, because everything I look at is flashing an orange warning. Lastly, I want to show you a chart of weekly chart of EEM. It's quite possible this is an A, B, C, in which case 40-40 is the objective, and that is going to be very good risk reward. But if we get what is that, an 8%er here, it's unlikely that we don't get a 4%er, let's say, in S&P, maybe a 5%er, which is then driven by something like a 7, 8, 9% in tech. So everything is really coming together for the potential of 1,000 points easily in NQ. And that is the danger, and that is why I'm showing you the orange light, so you can make up your own mind about which tech stocks you want to own at this very moment. And so on to the biases. I haven't really changed very much from last week. The most notable things are the FX now looking to pick them up at 98, 40, 50. That was achieved. NQ to me is the extreme danger here, because to me the real support is not till 8100. Now that is a long way away, and nobody's saying that we're going to get that next week. But the levels of support that you are looking for to buy it for some bounce are 93.10, 9100 and 89.50. This is excellent support for next week, and I'm not even saying that we're going to see it, but I'm saying if we do see it, it's a very good risk reward trade on the upside. Everything else really is very much unchanged, but apart from EM, which now tells me that you could see this ABC target to the 40-ish level that I indicated. I'm still a bull. I still think all this ultimately results higher. I'm just pointing out that we are having a confluence of signals and events and fundamentals which could, it is coming together into some sort of a perfect storm. Be careful, because it will get quite hairy at some stage, I'm convinced. Thank you very much indeed, and tweet you on Monday.